appears quite possibly that I may have had to sign in to an account to get full access to the answers that Google Gemini is telling me. So my first question of today, June 16th, 2026 is, what are the best stocks to buy in 2026? When looking for the best stocks to buy, the right answer depends entirely on your strategy. Whether you are looking for stable compounders to anchor your portfolio, aggressive growth riding the AI wave, or reliable dividends to generate passive income. Major research firms and analysts point toward several high conviction ideas across distinct investment styles. And when we scroll down here, we can take a look at it and see number 1, stable core compounders. And we can go a little bit lower and see, oh look, Google made it. Google made it at the very top. Oh wow, I'm not surprised at all. And second, we have Amazon and even Visa. Everybody loves their Visa card. Everybody loves their credit cards and debit cards. So number 2, we have high growth and infrastructure plays. So we have Constellation Energy, a few other ones, Micron Tech, and Broadcom. What else do we have? Defensive and value opportunities. Well, you learn something new every day. We have a smart alternative, which is index funds. Wow, I definitely have heard of the NASDAQ 100, but that is very interesting. I learned something new. So right here we have a note. Stock markets fluctuate constantly based on economic data, corporate earnings, and interest rates. It is always a good idea to align your stock picks with your personal time horizon and risk tolerance. Where should we focus next based on your financial goals? Well, it does say at the bottom, Gemini is AI and would or could make mistakes. So, it's giving me some information. But what would be the point of what's the point of it giving me information unless the information is actually factual and true? Okay, where should we focus next based on your financial goals? How to start investing with index funds. Building an automated index fund portfolio is one of the most effective ways to build wealth because it removes 2 of the biggest enemies of investing: high fees and human emotion. Yeah, you can't really rely on human emotion a lot of the time if you expect to get things done, unless it's a good emotion like love or something. By using broad market exchange traded funds, EFTs, you can own thousands of global companies with a single purchase, and by automating it, your portfolio grows quietly in the background. That sounds good to me. So yeah, that's my first question, and I see it basically says that the best stock to invest in is Google, and that's totally not biased at all, right? It's totally not biased. Okay, well, the first time I asked it, when apparently Gemini would have malfunctioned, it had told me SpaceX was actually one of the best ones too. Okay, so the next question is going to be how to make passive income in 2026. So Google's telling me that the concept of passive income would commonly be misunderstood. In reality, it will fall into 2 categories: investing your money or investing your time. The passive income landscape has shifted. AI tools have flooded the internet with low-quality content, and you can't have low-quality content, meaning success now relies heavily on human authenticity and hyper-focused niches. The best strategies are broken down by what you have more of right now: money or time. So basically, if you have more money, the best way to make passive income based on Gemini, which is an AI and would or could make mistakes, is dividend growth EFTs, real estate investment trust, or high yield cash management. And then path B is if you have more time. These require 0 to very little startup cash, but you will need to put in heavy, focused work upfront before seeing a single dime. Well, I like seeing a lot of money up front, but that's just me. It works good for people who have the option to choose, and if that's their choice to choose that one, that's good for them. So high value digital templates is number 1. Micro software as a service. What even is that? The emergence of powerful no-code builders like Bubble, Lovable, or Bolt means you don't need to be a software engineer to build a tech product, not project. But, oh wow, you don't even have to go to school anymore to be a software engineer. Goodness gracious. No, just kidding. You just use your AI. So, would I be just kidding? The focus. Solve a tiny problem for a specific business niche. The secret. If you can get 100 people to pay you $20 a month subscription for a tool that solves something, you have a 20, why did I say 20? 2000? Yeah, it is 2000 a month reoccurring income stream, but it says 2000. Hyper niche. Affiliate marketing, newsletters. Wow. Generic blogs would be struggling against AI search engines. Wow. But authentic, community-driven content is thriving. That's very interesting. The focus. Build a highly specific newsletter using platforms like Beehive or Substack, or a YouTube channel around a deeply specialized hobby or profession. The secret. You don't need millions of followers. Well, if you have millions of followers, that's great though. If you have 2K deeply engaged readers, companies in that specific industry will pay premium rates to sponsor your content or pay you high affiliate commissions to recommend their software. The reality check. Every true passive income stream follows a predictable life cycle. Understanding this prevents you from giving up too early. Yeah, I am not the type to give up on certain things. If it would be something that I don't care about, then yeah, why not? If I'm committed to something, I can't really give up on it though. Phase. Time invested approach. Okay, so the phase for the first one's month 1 through 3. That's the grind. Takes 99% effort, 1% profit. Building a product from a beginning audience. That's the time invested approach. So we have the money invested approach. It's 99% accumulation, 1% payout. Lowering your lifestyle to invest cash. Interesting. And then we go down the list. At the end of the period, or over a 2-year period, the true passive growth here is when this 1% profit turns into 95% profit and the content ranks organically. Very good. It sounds very good. That's a huge upscale in the profit. So, which asset class matches your current resources best? Well, personally me, I just prefer to pay for things, so yeah. I actually would choose the investment over the free strategy. Actually, I can do a mixture of both, or I would do a mixture of both. So, let's see, what is the next question? The next question that we are asking Google Gemini is, I had to think about that for a moment, but the next question is how to make money online in the year 2026. So this goes along with that, having passive income, how to make money online, it's all like in the same field. The online money-making landscape has undergone a major shift. The market is completely flooded with generic, oh no, you can't have low-effort AI text and images. So success now belongs to creators and operators who provide deep niche expertise, absolute transparency, or high-end technical execution. So basically it keeps saying the same thing over and over again, like with every question I type. But yeah, that's the answer that Gemini likes to give out. So, high-value digital micro products. Number 1. Number 2, no-code micro software as a service. Number 3, the expert newsletter and private communities. Number 4, hyper-local digital agency. If any of you need to read this, you can pause it at some point. So, how to choose your path. To avoid burning out or wasting months on a project that doesn't make money, use this simple framework to decide where to start. And then it tells you your best approach and how much time it takes to make the first dollar over here. A note on authenticity. No matter which path you choose, lean heavily into video and personality, because the internet is full of faceless automated content. Showing your real face, your actual voice, and your genuine behind-the-scenes process is your single greatest competitive advantage. Which of these directions fits your current skill set or interest best? Gemini seems that it will give very limited information about some things, but it does give good information. It just seems like it can add more and talk about different things, but maybe if you ask other follow-on questions, it does. But now my next question is, what are all the generations, including baby boomers? Okay. While there is no single official governing body that sets the exact boundaries for social generations, demographers and research groups like the Pew Research Center and the U.S. Census Bureau have a widely accepted consensus. The social generations are listed below in chronological order, starting from the oldest living generation to the newest group currently being born. It says the greatest generation are the years between 1901 and 1927. So their current age today are 99 to 125, which would mean most of them have expired. It says over here some other things. How can I see the whole screen? It says they lived through the Great Depression. The silent generation are from the years between 1928 and 1945, which means right now they are between 81 to 98. Baby boomers are 1946 to 1964. Are my parents baby boomers? Yeah, they actually are. That's very interesting. Then we have Generation X. Generation X is from 1965 to 1980. That's also interesting. Then we have the millennials, which are between the years 1981 to 1996, and their ages are 30 to 45. Next down we have Gen Z. That's the years 1997 to 2012, and the ages from 14 to 29. Currently, that's the ages they are. Generation Alpha are between 2 and 13 years old right now, born between 2013 and 2024. And the last one, the most recent generation, that's going to be going all the way up to 2039. So all the babies born between 2025 up to 2039, they're all going to be Generation Beta. These are all these new future babies, and they're between the ages of 0 to 1. Okay, what are microgenerations? Sociologists call these boundary groups microgenerations or cuspers. Interesting. Sooner boomers, the bridge between the silent generation and the baby boomers. Generation Jones. Wow. Oh, would you like to explore a specific generation further? Well, no. Let me think about my next question for you, Gemini. So my next question is it really worth it to invest in Bitcoin? Is it worth it? It has to be for some people. Whether investing in Bitcoin is worth it depends entirely on what role you want to play in your financial life. If you're looking for guaranteed stable investment to anchor your retirement next year, the answer is a definitive no. But if you have a long time horizon, high risk tolerance, and want a high upside alternative asset, it can absolutely be worth a small spot in your portfolio. The bull case. Why people invest. Proponents of Bitcoin view it as a revolutionary financial technology. The main arguments for holding it include scarcity by design. There will only ever be 21 million Bitcoins in existence. Unlike traditional currencies like the US dollar, which central banks can print at will, Bitcoin supply is hard-coded and cannot be inflated. This is why many call it digital gold. I see. Institutional adoption. Bitcoin is no longer just a hobby for tech enthusiasts. With the approval of major spot Bitcoin EFTs by companies like BlackRock and Fidelity, it is now deeply integrated into traditional financial systems. It is easier than ever for regular investors and pension funds to add it to their accounts. The halving cycles. Every 4 years, the amount of new Bitcoin created is cut in half, an event called the halving. Historically, this programmatic reduction in supply has acted as a catalyst for multiple year price increases. My next question is, are coins going to become obsolete? I doubt it. Let's see what Gemini has to say about this question. The short answer is no. Coins as a whole are not becoming entirely obsolete just yet, but they are shrinking rapidly in relevance. Are they really? While you will still see quarters, dimes, and nickels for years to come, we are witnessing the beginning of the end for the lowest value coins. Physical currency is shifting away from daily commerce and transforming into a backup safety net. Several factors explain the current reality of what is happening to the pocket change in your wallet. The death of the penny. The most significant shift in currency has been the official phase out of the 1-cent piece. The U.S. Treasury officially halted the production of pennies for general circulation, following in the footsteps of countries like Canada, Australia, and the UK. The math behind the decision became impossible to ignore. It cost the U.S. roughly 3.7 cents to manufacture and distribute a single 1-cent coin. Taxpayers would have been losing over $85 million a year just to print a coin that most people immediately toss in a jar or lose in the couch. Wow. While existing pennies remain legal, tender banks are no longer receiving new shipments. Over time, businesses will naturally transition to rounding cash transactions to the nearest nickel, rendering the penny practically obsolete. That's interesting. The next target, the nickel. Why higher value coins are sticking around? Quarters and dimes are much safer from extinction, primarily because they still serve a practical purpose and, critically, they actually make money for the government. A quarter costs significantly less than 24 cents to produce. Well, let me just go up and read number 2. Why would I skip that? The next target, the nickel. With the penny gone, a nickel is now the most expensive coin to produce relative to its worth. The metal composition, copper and nickel, mean it also costs more than 5 cents to manufacture, while the government is currently keeping a nickel in circulation and exploring cheaper metal alternatives. We have cash versus digital. The decline of coins is directly tied to how fast society is adopting digital payment rails. Interesting. The verdict. Coins aren't going to vanish overnight. Instead of a sudden disappearance, you will experience a slow fade. You will notice fewer coins in circulation, more businesses rounding cash totals, and an increasing number of registers displaying card-only signs. Pocket change is transitioning from a daily tool into a historical backup system. Yeah, I find it pretty interesting. I have seen some places that used to allow cash years ago not take cash anymore. They all only accept digital payments, but most places do still accept cash. My next question is, what are the best video editing softwares to use in 2026? Choosing the best video editing software for YouTube depends entirely on your experience level, the type of content you make, long form versus short form, and the power of your computer. The industry has firmly shifted toward AI-assisted workflows such as automatic captions, text-based editing via transcripts, and AI-driven auto-enhancement, which means editors are spending less time on tedious tasks and more time on the actual creative cut. The heavyweight professional standards. If your goal is high-end production value, multi-camera setups, advanced color grading, or working with a production team, these are the industry benchmarks. Adobe Premiere Pro, DaVinci Resolve, Final Cut Pro. Those look like they're the top 3. Number 2, fast-paced creators and short-form social tools. If you feel like reading about these editors, I'll put it on here for a few seconds and you can pause it. So, number 2, fast-paced creators and short-form social tools. If you don't care about advanced Hollywood color grading and just want to push out highly engaging YouTube shorts, tutorials, or podcasts as fast as possible, you want tools designed for speed, and those are going to be CapCut Desktop, Descript. Which one is that? So apparently those ones are for fast short videos. And then we have right here Software Selection Matrix, Premiere Pro, DaVinci Resolve, Final Cut Pro, CapCut Desktop. I've heard of all of them except for Descript. Okay, so CapCut is for beginner and apparently Descript is too. Final Cut Pro is intermediate. DaVinci Resolve is for advanced, and Premiere Pro is also for advanced. CapCut Desktop is free, and DaVinci Resolve appears to be free and you can upgrade, and it looks like you can upgrade in CapCut. But you do know, Gemini is an AI and it would or could possibly make mistakes. So before buying anything, this is a pro tip. Download the free version of DaVinci Resolve or CapCut Desktop. Test them out with a few test clips to see if your current computer handles the rendering smoothly and if the timeline layout matches your natural creative workflow. Want to dial in your setup based on your specific content or device? Okay, well, I'm using a Windows computer right now. For a comprehensive look at how the software suites match up in actual production environments, you can check out the top 5 best video editing apps comparison video. It provides a real-time of tools like Premiere, Movavi, and CapCut, so you can see which style fits your editing pace. I use Windows right now. Since you're on a Windows PC, that immediately rules out Final Cut Pro, but it leaves you with the 2 best ecosystems for YouTube video production, Adobe and DaVinci, alongside excellent short-form tools. Because Windows PCs have massive hardware variety, your choice should match how powerful your computer's components are. The High Power Pro standards requires a dedicated GPU. If your PC has a dedicated graphics card and a powerful multi-core processor, you can easily run the industry standards. DaVinci Resolve's free version is there, and then they have a $295 version. Where did it go? Adobe Premiere Pro is $23.99 a month, and you could use both of those on Windows. Number 2, the mid to low power speed tools, Clipchamp and CapCut. Yeah, I prefer the high power one. Your Windows action plan. Number 1, check your graphics hardware. Number 2, match software to your GPU type. Number 3, configure your storage drive. How should we dial in your Windows editing setup? Okay, well, I'm just going to ask the next question now. So, what is my next question? My next question is, what are the best areas to live in the United States? Because the best area to live depends entirely on your lifestyle, budget, and career goals, there is no single city that fits everyone. However, data from major index rankings like US News and World Report, Livability, and Bankrate point to a massive nationwide trend. The highest rated areas are those offering a strong job market and premium amenities without the hyper-expensive price tags of coastal hubs. The top areas to live are categorized by what they do best. Number 1, the top consensus picks: affordable suburbs with city perks. If you want safe neighborhoods, top-tier public school systems, and blooming local job markets, mid-size and southern suburbs are completely dominating national rankings. This is going to be in Indiana, Dallas, Fort Worth area, Sugar Land, Texas, places like these. Number 2, we have high growth tech and academic hubs. If you are a remote worker, tech professional, or entrepreneur looking for a highly educated community surrounded by culture, these areas are thriving. We have North Carolina, Huntsville, Alabama, places like this. Number 3, the powerhouse global metros. If your definition of a great place to live means world-class walkability, unmatched public transit, and a non-stop cultural heartbeat, the major legacy metros still hold the title for sheer opportunity, though they require a premium budget. Think places like New York City and Los Angeles, California. How to filter your selection. When deciding where to move, use this quick framework to align your priorities with the right region. If your primary goal is maximizing savings and family safety, then your best target areas are mid-size, Midwest, and southern suburbs. If your primary goal is tech career growth and moderate cost, then your best target areas are Southeast and Central Texas hubs. If your primary goal is walkability, culture, and elite career scale, then your best target areas are major coastal urban metros. Which lifestyle factor is most important for your next move? What are the states with no state income tax, and how do their property taxes compare for real estate? There are 9 states with no state income tax. However, state governments have to fund infrastructure and public services somehow. If they aren't taxing your paycheck, they are usually collecting that money through higher sales taxes or higher property taxes. Before moving to a tax-free state, it is vital to look at the real estate trade-off. Some of these states boast incredibly low property tax rates, while others have some of the highest and most aggressive property tax bills in the country, the high property tax group. In these states, the money you save on your income tax returns is often redirected straight into your local county property tax bill. These states are going to be states like New Hampshire, Texas, Iowa, Illinois, and Nebraska. The sweet spot. These states offer the ultimate tax advantage: no state income tax combined with average or below average property taxes. They usually pull this off by funding their states through massive tourism, gaming, or natural resource sectors. These states include places like Nevada, Wyoming, and Tennessee, Alaska. The mid-pack trade-offs. Florida features an average effective property tax rate of roughly 0.74% to 0.89%. While the tax rate itself isn't terrible, Florida homeowners face a different real estate crisis. Homeowner insurance premiums, which are currently the highest in the country due to hurricane risk. Washington and South Dakota both feature very middle off-the-road effective property tax rates around 0.90% to 1.5%. Washington makes up for its lack of income by levying some of the highest state sales and gasoline taxes in the United States. Financial summary matrix. So in Nevada, there is 0% state income tax. In Wyoming, we have 0% state income tax. In Tennessee, we also have 0% state income tax. In Florida, we have 0% state income tax. In Washington, Texas, and New Hampshire, these also have 0% income tax, 0% income tax, 0% income tax. We see that for the average effective property tax, Nevada has the lowest in this list, coming in at 0.48%, and with the highest average effective property tax, New Hampshire comes in at the highest at 1.77%. The takeaway. If you are a high-earning professional or remote worker moving to a state with 0 income tax, you will almost always come out ahead financially. Yes, you will almost always come out ahead financially. But if you are a retiree with lower annual income buying an expensive home, moving to a higher property tax state like Texas or New Hampshire could actually increase your tax burden annually. Always run the math on the specific home value you plan to buy. Are you planning a move or looking to optimize your real estate strategy? My next question is, how many millionaires and billionaires are there in the United States? The United States is home to the largest populations of both millionaires and billionaires in the world. When looking at the numbers, it helps to separate them into 2 groups because millionaire can be defined in 2 distinct ways: by total net worth, including homes, or by investable assets, liquid wealth. How many billionaires are in the U.S.? According to the Forbes World's Billionaire list, there are 989 billionaires in the United States. The U.S. has more billionaires than any other nation, making up nearly 29% of the world's total billionaire population. Driven largely by surges in technology, artificial intelligence, and stock market growth, this elite group holds a combined wealth over $8 trillion. How many millionaires are in the United States? The exact number of millionaires depends entirely on how wealth is calculated. Major financial reports look at this through 2 different lenses. Definition A, total net worth. The traditional view. The count, approximately 24 million individuals. What it includes. This counts anyone whose total assets, including equity in their primary home, 401k plans, retirement accounts, business, and investments, minus any debts like mortgages, equals $1 million or more. The reality. This represents roughly 8.8 of all American adults. Definition B, high net worth individuals, the liquid view. The count, 8.7 million individuals. So here we have the U.S. wealth pyramid. The wealth tiers we have here, billionaires worth over $1 billion. There are approximately 989 individuals in the United States. Ultra high net worth individuals worth over $30 million. There are approximately 100,000 individuals in the United States that have ultra high net worth over $30 million. The liquid millionaires. There are approximately 8.7 million individuals who have over 1 million investable dollars in the United States. And then we have the total net worth millionaires. There are approximately 24 million individuals that have over $1 million plus of total assets in the United States. Summary fact, about 39% of all the millionaires on Earth live in the United States, despite the country making up of just over 4% of the global population. Curious about how this wealth is distributed or built? Well, my next question is actually how many trillionaires exist? There is officially one confirmed trillionaire in the world, Elon Musk. Musk crossed the historic $1 trillion threshold following the massive initial public offering (IPO) of SpaceX. The rocket, satellite, and AI conglomerate debuted on public markets at a valuation exceeding $2 trillion, which vaulted Musk's personal net worth, combining his massive stakes in SpaceX and Tesla, to over $1.1 trillion. The path to the first trillionaire. For years, economists debated when the world would see its first trillionaire, with most predictions pointing toward the late 2020s or early 2030s. The milestone was achieved sooner than expected, due to two primary factors. The SpaceX IPO. Going public shattered global records at the largest IPO in history, raising about $75 billion because Musk held a roughly 42% equity stake in the company. The debut handed him an immediate, unprecedented windfall of over $800 billion. The artificial intelligence boom. SpaceX's massive valuation was heavily driven by its integration with Musk's AI startup xAI. The construction of massive colossus supercomputing data centers. Wall Street treated this listing as a premier AI stock, driving massive investor demand. Who is closest to joining him? While Musk is currently the sole member of the Trillionaire Club, the hyper-growth of the tech and semiconductor sectors means a few other ultra-wealthy founders are within striking distance over the coming years. According to real-time billionaire trackers, the individuals closest to the mark include Jeff Bezos of Amazon, Mark Zuckerberg of Meta, Larry Page and Sergey Brin of Google, and Jensen of NVIDIA. An important nuance, just like regular billionaires, a trillionaire's wealth is almost entirely on paper. Musk does not have $1 trillion sitting in a bank account. His wealth fluctuates by tens of billions of dollars a day, based entirely on volatile stock prices of SpaceX and Tesla. Want to explore the implications of this unprecedented wealth? Well, sure I do. How has the global wealth gap changed with the rise of the AI boom and the creation of the first trillionaire? The twin forces of the artificial intelligence boom and Elon Musk's recent leap into trillionaire status, fueled by the historic SpaceX IPO, have triggered what economists are calling an acceleration phase in global wealth inequality. According to data from the World Inequality Report, the wealth gap isn't just widening anymore, it is compounding at a speed never before seen in modern history. The global wealth gap has structurally changed across several key dimensions. Number 1, the shocking scale of concentration. Number 2, the AI divide, corporate and high net worth surges. The broader AI boom has acted as a massive wealth multiplier for the already wealthy because AI requires historic levels of capital expenditure to build data centers and buy microchips. The financial rewards have been heavily concentrated at the very top of the tech ecosystem. Billionaire wealth acceleration. Global billionaire wealth surged by 16%, reaching a record $18.3 trillion. This rate of wealth accumulation is 3 times faster than the average annual increase seen over the previous 5 years. The rise of the liquid millionaire. Data from the World Wealth Report highlights the global high net worth individual wealth increased by 8.7% to $98.3 trillion, with the population of millionaires jumping to 25.3 million. Investors who already had capital deployed in AI-focused enterprises and equities reaped massive windfalls. The historic asymmetry. Today, the top 10% of the world owns 3/4, 75% of all global wealth, while the bottom half of the global population holds a mere 2%. The structural shift in labor and capital. While tech founders and venture capitalists are seeking vertical spikes in wealth, the AI boom is beginning to alter the financial floor for everyday workers. The Great Debate, the ceiling versus the floor. The arrival of the trillion-dollar era has fractured economic philosophy in 2 main camps, the liberal sufficientarian view and the democratic socialist NGO view. The rise of tech-driven wealth inequality is reshaping global policy. What aspect should we explore next? Let's look at proposed global wealth taxes. What are the latest global proposals for minimum wealth taxes on billionaires and multimillionaires? The global conversation around taxing billionaires and multimillionaires has shifted from theoretical activism into formal, highly debated policy proposals. Driven by the massive wealth accumulation of the AI boom, world leaders and major economic bodies are introducing concrete frameworks to establish a floor for taxing the ultra-wealthy. The most notable global and domestic minimum wealth tax proposals are moving through legislators. The G20 Global Minimum Tax on Billionaires. The most prominent international framework is a proposal commissioned by Brazil during its G20 presidency, designed by French economist Gabriel Zucman. Number 2, the United Nations Tax Convention fight. Number 3, the domestic spotlights. The United States. Because a global consensus requires individual nations to pass their own laws, domestic wealth tax battles are intensifying, particularly in the U.S. The federal level, the billionaire minimum income tax. Repeatedly proposed in the federal budget blueprints, this plan targets households worth over $100 million, the top 0.01% of Americans. It would impose a 25% minimum tax rate on true economic income, which critically includes unrealized capital gains. The California 2026 Billionaire Tax Act. Because federal wealth taxes face steep constitutional challenges in the U.S., progressive states are taking matters into their own hands. California voters are facing a landmark ballot initiative for the November election. The proposal, a one-time 5% wealth tax on the global net worth of billionaires residing in the state. The mechanics. The tax would apply to worldwide assets, stocks, bonds, intellectual property exceeding $1 billion, excluding directly held personal real estate. To prevent billionaires from quickly fleeing the state to evade it, the law features an aggressive snapshot residency clause locking in anyone who was a resident. The yield. It is projected to raise $100 billion over 5 years to fund state health care, Medi-Cal, public education, and food assistance. My next question is, how do you increase your financial wealth in 2026? Increasing your financial wealth requires adapting to a unique macro environment. Top financial institutions like JP Morgan and Morgan Stanley emphasize that the era of ultra-low inflation and seamless global trade is over. Building wealth requires navigating stickier, more volatile inflation and an economy driven by massive corporate AI capital investments and slightly easing but still elevated interest rates. A modern multi-step playbook can help you maximize your wealth building. Number 1, pivot away from heavy cash holdings. While keeping cash in high yield savings account was a great strategy when rates peaked, the Federal Reserve's rate cutting cycle is lowering those yields toward 3% to 4% range. Number 2, target the AI diffusion and infrastructure supercycle. The tech trade has matured. Wealth creation isn't just about buying speculative software startups. It's about investing in the physical foundation required to build the future. Tech giants are spending hundreds of billions of dollars on capital infrastructure, energy and power grid. Data centers consume an immense amount of electricity. Companies specializing in nuclear energy, independent, clean power, like Constellation Energy, and physical grid infrastructure are experiencing massive structural growth. Number 3, protect purchasing power with real assets. Because inflation is expected to remain structurally volatile, a traditional portfolio of just stocks and bonds may experience choppy waters. Institutional wealth managers are heavily leaning into real assets that have intrinsic value and can pass costs directly onto consumers. Number 4, execute the wealth-building foundations. Regardless of the macroeconomic backdrop, the core mechanisms of building wealth never change. They simply require strict automated execution. Optimize your debt. Firstly. Number 2, maximize tax-advantaged accounts. Number 3, automate dollar cost averaging. This right here is the wealth building summary matrix. As we scroll down a bit, we can see everything that it has to offer. Which lever of wealth building should we optimize first? My next question is, which vehicles get the best gas mileage in the year 2026? If you are looking for the absolute best gas mileage on the market, traditional non-plug-in hybrids take the crown. Automakers have aggressively expanded their hybrid lineups, pushing standard fuel economy to heights that were once considered impossible for everyday commuters. According to the official EPA ratings and automotive data, the top-performing fuel-sipping vehicles are organized by category. Number 1, the ultra-efficient leaders. These get over 50 miles per gallon, and they are, here we have the list, the Toyota Prius, which gets over 57 miles per gallon as a hatchback, the Hyundai Elantra Hybrid, which gets over 54 miles per gallon as a compact sedan, the Kia Hybrid, whoa, where did it go? Right here, it's a subcompact SUV that gets over 53 miles per hour. The Toyota Camry Hybrid, which is a mid-size sedan that gets over 51 miles per gallon. The Hyundai Sonata Hybrid, mid-size sedan, which also gets over 51 miles per gallon. And the Toyota Corolla Hybrid compact sedan, which averages over 50 miles per gallon. Number 2, we have the best-in-class utilities and pickups. If you need more ground clearance, passenger space, or a cargo bay, you don't have to sacrifice great fuel economy. Number 1, the high-efficiency crossovers. They get a combined 42 miles per gallon. Vehicles like the Toyota Corolla Cross Hybrid and the Kia Sportage Hybrid lead to the true crossover class at 42 miles per gallon. They offer standard all-wheel drive alongside massive city fuel savings. Number 2, the compact SUV benchmarks. These get between 38 to 40 miles per gallon combined. The newly redesigned Toyota RAV4 Hybrid and Honda CR-V Hybrid sit comfortably at the 38 to 48 miles per gallon mark. These are the two most popular SUVs in America because they balance cargo space perfectly with commuter car fuel bills. Number 3, the fuel-sipping pickup truck. 38 miles per gallon combined for the Ford Maverick Hybrid. It completely dominates the truck space, getting an incredible 42 miles per gallon in the city and 38 miles per gallon combined. It proves you can drive a practical utility bed without a painful gas station bill. And finally, at number 4, we have the 3-row family haulers. These have a combined 36 mile per gallon capacity for larger families. The Toyota Sienna minivan and the 3-row Hyundai Santa Fe Hybrid both achieve 36 miles per gallon combined. Compared to traditional V6 family SUVs that get 20 miles per gallon, this strategy cuts family fuel expenses nearly in half. A quick real-world reality check. Keep in mind that EPA ratings are tested Under idealized laboratory conditions, real-world testing reveals that hybrids crush their ratings in stop-and-go city traffic where the electric motor does the heavy lifting. Their efficiency will naturally dip closer to the mid-30s if you are driving at heavy highway speeds or through freezing winter weather. Are you trying to narrow down the perfect commuter or family vehicle? My next question is, what are the easiest wealth strategies to understand? The easiest wealth strategies to understand are those that require zero financial expertise, don't rely on guessing the future, and can be completely automated. The 3 simplest, most reliable wealth building frameworks are broken down below, ordered from the absolute easiest to the slightly more advanced. Number 1, the pay yourself first strategy. The concept most people get paid, pay their bills, buy groceries, spend money on entertainment, and then save whatever is left over, which is usually nothing. This strategy flips that equation upside down. How it works: the exact day your paycheck hits your bank account, a set percentage, 10 or 15%, is instantly and automatically moved out of your checking account and into a savings or investment account. Why it's so easy? You never have to exercise willpower. You simply learn to live on whatever money is left in your main checking account. If you never see the money, you don't miss it. Or if you always have the money, you don't miss it either. Number 2, dollar cost averaging into index funds. This is the strategy used by legendary investor Warren Buffett. It completely eliminates the stress of trying to time the stock market. The concept: instead of trying to guess when stocks are cheap or expensive, you buy a fixed dollar amount of a broad market index fund like an S&P 500 EFT on a regular schedule, no matter what. How it works: you set up an automatic rule: every Friday buy $50 worth of Vanguard's S&P 500. When the stock market is crashing, your $50 automatically buys more shares because they are on sale. When the stock market is at an all-time high, your $50 automatically buys fewer shares. Why it's so easy? Over 10, 20, or 30 years, this mathematically averages out your purchase price. You win by simply being consistent and letting the overall growth of the economy lift your net worth. Number 3, the 3-fund portfolio. If you want a complete, globally diversified investment portfolio but don't want to manage a mess of individual stocks, this is the gold standard of simplicity. Concept: you own the entire world's economy using just 3 exchange-traded funds, EFTs. How it works: you open a brokerage account and split your savings into 3 buckets. Bucket number 1, total U.S. stock market. Bucket number 2, total international market. And bucket number 3, total bond market. The customization: if you are young, under 35, you might do 80% U.S. stocks, 20% international, and 0% bonds. As you get older, you slowly add more to the bond bucket to protect your nest egg. Summary: the lazy wealth routine. Building wealth does not require checking charts, reading financial news, or trading stocks daily. The easiest, most effective path looks like this. Number 1, open a tax-advantaged account. Number 2, pick 1 or 2 index funds. Number 3, automate and walk away. Which of these basic concepts makes the most sense for your current financial situation? My next question for Google Gemini is, can you teach me financial literacy? Financial literacy is the single most valuable skill you can learn. It's not about memorizing complex math or watching stock charts all day. It is simply about understanding how money moves, how to protect it, and how to make it work for you. Think of financial literacy as a ladder. You cannot safely step onto the higher rungs until you build a solid foundation at the bottom. Rung 1, the cash flow equation, budgeting. Wealth isn't determined by how much money you make. It's determined by how much money you keep. Every financial plan starts with mastering cash flow. The easiest, most flexible framework to understand is the 50-30-20 rule. When your paycheck hits your account, split your take-home pay into 3 distinct buckets: 50% for needs, 30% for wants, and 20% for savings and future. Rung 2, building the safety net. Emergency funds. Before you spend a single dollar trying to buy stocks or crypto, you must build a financial shield. Life will eventually throw an unexpected expense at you. The goal: save 3 to 6 months worth of your essential living expenses. Where to put it? Keep it in a high-yield savings account. High-yield savings accounts are fully insured by the government, FDIC, but they pay significantly higher interest rates, allowing funds to grow safely against inflation while remaining completely accessible. Rung 3, defeating high-interest debt. Not all debt is created equal. Understanding the difference between good and bad debt is crucial for your financial health. Good debt is low interest. Bad debt, high interest. The financial rule: paying off a credit card with a 22% interest rate is mathematically the exact same thing as getting a guaranteed 22% return on your investment. No stock market index can match that. Treat high interest debt like a financial emergency and pay it off aggressively. Rung 4, making money work for you. Investing. Once your debt is gone and your fund is full, you are ready to invest it. Investing is how you stop trading your time for money and let compounding interest do the heavy lifting. The greatest misconception is that you need to be a stock market genius to win. You don't. The most reliable beginner-friendly strategy is to buy broad market index funds. What is an index fund? Imagine instead of buying one share of Apple stock, you buy a basket that contains a tiny piece of the 500 largest companies in America, the S&P 500. If one company fails, the other 499 lift the basket. Historically, the U.S. stock market has averaged an approximate 10% annual return over long multi-decade periods. The ultimate wealth-building roadmap. To put financial literacy into immediate action, execute these financial steps in exact sequence. Number 1, audit your accounts. Number 2, secure $1,000 immediately. Number 3, melt the high interest debt. Number 4, grab the free corporate match. Number 5, automate your investments. Financial literacy is a personal journey. Where should we start building your custom plan? My next question for you, Google Gemini, is what are your top stock app picks for 2026? The best stock app depends entirely on how you want to manage your money. The trend relies heavily on automated features and AI-driven insights, making it easier to manage a portfolio directly from your phone. The top stock and investment apps are categorized by how they fit your investing style. Number 1, best for beginners, Robinhood. Number 2, best for passive micro investing, Acorns. Number 3, best for mobile day traders, Webull. Number 4, best in all-in-one super app, SoFi Invest. Number 5, best for long-term traditionalist, Fidelity Investments. Depending on your experience level, we can dive a bit deeper. My next question is, what are the best apps for buying cryptocurrency? Just like traditional stock apps, the best app for buying cryptocurrency depends on what you value most: low fees, maximum security, ease of use, or advanced trading tools. The crypto app market is highly regulated, and the top platforms are divided by user style. Number 1, best for absolute beginners, Coinbase. Number 2, best overall for fees and security, Kraken Pro. Number 3, best for casual and multi-asset investors, Robinhood. Number 4, best for everyday rewards, Crypto.com. Features and cost comparison. Right here we can take a look at this chart, and it has the target users, base trading fees,
and notable features. The golden rule of crypto: not your keys, not your coins. When you buy crypto on apps like Coinbase or Robinhood, they act as a custodian, meaning they hold the keys to the digital vault. For small amounts, that is fine. But if you plan on building a serious crypto portfolio, financial literacy dictates that you eventually move your assets off the exchange app and into a self-custody hardware wallet like Ledger or Trezor device. This ensures that even if an exchange app goes bankrupt or offline, you still physically own your assets. Crypto involves a mix of trading mechanics and storage safety. Where should we look next? So my next question is naturally, what is Trezor? Trezor is a physical offline hardware wallet used to securely store the private keys to your cryptocurrencies. Invented in 2024 by a company called Satoshi Labs, Trezor was the world's very first crypto hardware wallet, which perfectly describes its purpose: keeping your digital assets in cold storage, completely disconnected from the internet to shield them from hackers, malware, and online exchange bankruptcies. How Trezor works. How a Trezor works. A common misconception is that your cryptocurrency is stored inside the device Trezor, or the Trezor device. It isn't. Your crypto always lives on the blockchain. The Trezor physically stores your private keys, the digital signatures required to move your funds. The Trezor philosophy: security through transparency. Trezor's biggest competitor is Ledger. While Ledger keeps its internal chips and operating system proprietary and closed source like Apple, Trezor is 100% open source. Every line of code, firmware, update, and hardware blueprint Trezor makes is publicly available online. Trezor believes that true security requires absolute transparency, allowing the global developer community to constantly audit their systems to ensure there are no hidden backdoors or vulnerabilities. The lineup. Trezor structures its lineup into the Trezor Safe family, ranging from essential security to to future-proof hardware. The golden rule of setup. When you unbox a Trezor, it will force you to write down a 12 or 24-word recovery seed phrase. This phrase is the master key to your entire wealth. If your Trezor is physically broken, lost, or stolen, you can type those words into a new device to instantly recover your funds. Never type these words into a computer, never take a picture of them, and never save them in the cloud. If anyone gets a hold of your seed phrase, they can steal your crypto instantly without needing your physical Trezor device. Are you considering setting up a cold storage wallet? Compare Trezor to Ledger in detail. What are the core differences between Trezor and Ledger hardware wallets in terms of security, features, and coin support? While Trezor and Ledger are the two absolute giants of the crypto self-custody world, they are built on fundamentally opposing philosophies. Choosing between them comes down to a classic tech debate: open source transparency versus hardened proprietary security. Number 1. Security architecture. Core philosophies. Trezor, open source purity. Ledger, closed source fortification. Number 2. Features and user experience. Companion apps. Hardware and mobile support. Number 3. Coin support. And this shows the differences between Ledger and Trezor ecosystems and features. The verdict: which fits your style? Choose Trezor if you are a Bitcoin maximalist, a long-term, long-haul investor, or an open-source purist. You want to buy your assets, transfer them to a completely transparent offline vault, and leave them untouched for years without dealing with Bluetooth or constant firmware ecosystem changes. Choose Ledger if you are an active crypto native who frequently interacts with DeFi, swaps altcoins, stakes for interest, tracks NFTs, or wants the absolute convenience of signing transactions securely from your iPhone all the way from your desktop. Ready to refine your hardware security strategy? My next question for you, Google Gemini, is what do you think about nanotechnology? Nanotechnology has undergone a fascinating evolution. For decades, it was treated like the ultimate science fiction concept, conjuring up wild images of microscopic nanobots swimming through our bloodstreams, or the industry has officially matured past the sci-fi hype, shifting from speculative lab experiments into a highly commercialized reality. Nanotech is less about a single headline-grabbing invention and more about an essential invisible backbone quietly revolutionizing four major pillars of the global economy. Number 1. The medicine frontier beyond one size fits all. The most profound impact of nanotechnology is happening in healthcare, specifically through nanomedicine. Number 2. Advanced computing, AI. If you are amazed by the recent explosions of artificial intelligence, you are actually marveling at nanotechnology. The advanced semiconductor microchips powering modern AI data centers are built on 2 nanometer nodes. To put that in perspective, a single strand of human DNA is about 2.5 nanometers wide. At this molecular scale, standard physics breaks down and quantum mechanics takes over. Engineers are using atomic layer deposition to pack tens of billions of nanotransistors onto a single fingernail-sized piece of silicone, extending the limits of computational power. Number 3. The clean energy shift. Building a sustainable future is fundamentally a material science, and nanomaterials are providing the answers. Next-gen batteries, green hydrogen, and carbon capture. So we have a little chart right here. It has the industry sectors, what it used to be, and the nano-enabled reality of the moment. The bottlenecks and red flags. Despite its massive success, nanotechnology faces 2 major friction points that keep scientists awake at night. Nanotechnology won't arrive in the form of a tiny metal robot waving at you. Instead, it is the invisible structural upgrade to everything around you. Nanotech spans from medical breakthroughs to quantum computing. Which path should we explore? My next question is, what are the major similarities and differences between financial advisors and tax attorneys? While both financial advisors and tax attorneys are elite professionals who can help you protect and optimize your wealth, they view your money through entirely different lenses. A simple way to remember the difference is that financial advisors focus on building and managing your wealth, while tax attorneys specialize in the legal interpretation of tax law and protecting you from legal disputes. The similarities, where they overlap. Despite having different degrees, the 2 professionals frequently collaborate because their work intersects in a few major areas. Tax optimization strategies, estate and succession planning, high net worth advisory. The differences, where they diverge. The true divide comes down to licensing, objectives, and legal boundaries. Core focus and objective. Financial advisors. Their primary goal is growth and lifestyle planning. They look at the big picture of your life, investing your money in the stock market, planning for your retirement timeline, setting up college saving funds, and managing investment risk. Tax attorneys. Their primary goal is legal compliance, dispute resolution, and asset protection. They focus strictly on the technical legal text of the Internal Revenue Code, IRC. They step in to structure highly complex corporate mergers, defend you against the IRS, or draft binding legal documents. Number 2, qualifications and credentials. Financial advisors typically hold financial certifications. The gold standard is a CFP or a CFA. They are experts in market economics, portfolio theory, and insurance. Tax attorneys are licensed lawyers. They hold a Juris Doctor degree. have passed a state bar exam, and often hold an advanced law degree, specifically in taxation. Number 3, legal scope and the line. Financial advisors can give general advice on tax-efficient investing. However, by law, they would not be able to give definitive legal interpretations of the tax code, prepare legal deeds, or represent you in tax court. Tax attorneys can draft legally binding documents. More importantly, they possess attorney-client privilege. Comparison summary. This is a comparison chart showing the differences between financial advisors and tax attorneys. Can you find tax attorneys at regular law firms? Yes, you can absolutely find tax attorneys at regular law firms. In fact, that is where a vast majority of them practice. Number 1, mid-sized and big law corporate firms. If you walk into a prominent multi-practice law firm in any major city, they will almost always have a dedicated tax practice group. Number 2, boutique tax and estate planning firms. These are smaller, highly specialized, regular law firms that reject general lawsuits or criminal defense to focus exclusively on wealth, estate, and tax matters. Number 3 would be tax controversy and litigation firms. How to find one on a firm's website.
Can you explain information technology to me? At its absolute core, information technology, IT, is the business of moving, storing, or protecting and processing data. Think of data like water. It is incredibly valuable, but only if you have the pipes to move it, reservoirs to hold it, filters to clean it, and a way to direct it to the people who need a drink. IT professionals are the engineers who build and maintain the entire water system for information. Whenever you send a text or ask an AI a question, you are using a massive, invisible web of information technology. The 4 pillars of IT. To understand how it shapes our digital world, it helps to break it down into 4 main categories. Number 1, hardware, the muscle. This is the physical world of technology, anything you can physically touch or kick. Examples: desktop computers, laptops, smartphones, keyboards, and the massive racks of industrial servers humming inside refrigerated data centers. The role: hardware provides the raw physical power and storage space required to run programs and hold data. Number 2, software, the brains. Hardware is just an expensive paperweight without instructions. Software is the code, applications, and operating systems that tell the hardware exactly what to do. Examples: Windows, Mac OS, mobile apps like Instagram, web browsers like Chrome, corporate databases, and complex enterprise video editors like Movavi. The role: software translate human commands into digital actions. Number 3, networking. The roads. Computers are isolated islands unless they can talk to each other. Networking is the infrastructure that connects them across the room or across the planet. Examples: Wi-Fi routers, fiber optic cables running under the ocean, cell towers, and communication protocols like the internet itself. Role: networking allows data to travel safely and instantly from device A to device B. Number 4, cybersecurity. Because data is highly valuable, people would always try to steal, corrupt, or hold it hostage. Cybersecurity is the defense mechanism built to protect the other 3 pillars. Examples would be firewalls, encryption keys, antivirus software, multi-factor authentication, MFA, and secure hardware vaults like the Trezor wallet. The role: it ensures that only authorized people can access specific data. What does an IT department actually do? When people say call the IT department, they usually picture someone fixing a broken printer or resetting a password. While that is part of it, often called help desk support, a modern IT department is actually split into highly specialized, strategic corporate roles. And here are the roles, what they actually do, and the real world analogy. And these would be common misconceptions, concerning IT versus computer science. People often use these terms interchangeably, but they are very different disciplines. Computer science is about creation. Computer scientists are software engineers and programmers who use complex math and code to build new software, apps, and AI systems from scratch. Information technology is about application. IT specialists take those created systems, install them, configure them, link them together, and make sure they operate reliably and securely for a business or individual. Analogy: a computer scientist designs and builds the engine of a car, an IT specialist manages the fleet, builds the garage, ensures the car runs smoothly, and maps the route. The world of IT is massive. Which angle would you like to explore next? What is another good topic for me to learn about? And this is what Google Gemini told me. There's actually a thunderstorm outside right now. If you hear that in the background, it's just rain hitting the window panes. Can you explain all the different types of insurances to me? Part 1. The personal big four. At number 1, we have health insurance. At number 2, we have auto, that's car insurance. At number 3, we have property insurance, which is homeowners and renters insurance. Number 4, we have life insurance. And this is where part 2 comes in, and that's income and specialization lines. That would be disability insurance, long-term care insurance, umbrella insurance as well. And here we are at part 3. This is commercial lines protecting business. This is general liability, and that would also be professional liability, workers' compensation, cyber liability, too. 3 essential terms you must know: premium, deductible, and policy limit. Insurance can get incredibly technical. Which specific area should we simplify next? What surpasses a trillionaire? Quadrillionaire is what surpasses a trillionaire. The naming convention for large numbers follows Latin prefixes multiplying by 1,000 at each new tier. Trillionaire, 12 zeros, quadrillionaire, 15 zeros, quintillionaire, 18 zeros. The real world context. To put this into perspective, humanity is only just witnessing the rise of its very first trillionaire. For a single individual to become a quadrillionaire in today's global economy would be practically impossible. A fortune of $1 quadrillion is over 10 times larger than the entire GDP of the planet Earth, which sits at roughly $100 to $110 trillion. For someone to surpass a trillionaire and reach the quadrillionaire tier, we likely have to enter the era of space-based hyper-capitalism, such as a single corporation successfully capturing and mining a heavy metal asteroid like 16, which contains enough gold, iron, and nickel to theoretically be worth an estimated $10 quintillion. Fascinated by the scale of massive numbers and wealth? Yes, I am actually. See the full list of large numbers past quadrillion. Sure. What are the names of all the large numbers after quadrillion, and how many zeros do they have? Let's take a look. Numbers up to 20. Whoa, go back down there. So we have quadrillion, 15 zeros, quintillion, sextillion, septillion, octillion, undecillion, duodecillion, tridecillion, quattordecillion, quindecillion, sexdecillion, septendecillion, octodecillion, novemdecillion. Whoa, go back up there. Is that vigintillion? Wowzers. The naming system continues indefinitely using patterns of those Latin prefixes, but there are a few famous milestone numbers further down the line that are frequently asked about. Trigintillion, goggle, like Google, centillion, googleplex. The quick formula. If you ever want to find the number of zeros for a specific standard illion, you can use the prefix's value, n. For example, quint means 5. The formula is zeros equals 3 times n plus 1. How many homes and houses can you purchase with that amount of money? Is it easier to manage homes or apartments as a landlord? When you ask a landlord which type of property is easier to manage, you will immediately get two completely different answers. The truth is that single-family homes are easier to manage logistically, but apartment complexes are easier to scale financially. It comes down to a direct trade-off between operational simplicity and economic safety. Number 1. Tenant dynamics. Winner. Single-family homes. Single-family homes, you deal with one lease, one family, and one personality. Because these tenants are renting an entire house and yard, they tend to stay significantly longer, often 3 to 5+ years. Lower turnover means less time spent cleaning, marketing, and screening new applicants. Apartments. You are managing a tiny community. Your job shifts from property manager to high school principal or mediator. You would routinely have to deal with neighbor disputes over noise, barking dogs, parking spaces, and shared trash bins. Furthermore, apartment tenants view their space as transitional and move out much more frequently, forcing you into a constant cycle of painting, cleaning, and relisting units. Number 2, maintenance and logistics. Winner, apartments. Number 3 would be the vacancy crisis. Winner, apartments. This is the operational comparison. Which is actually easier? Single-family homes are easier if you are a do-it-yourself or part-time landlord. If you want to manage your investments on the side while working a regular full-time job, dealing with a single long-term family in a house requires very little daily mental energy. Apartment buildings are easier if you want to build a hands-off business, because apartments generate a higher volume of raw monthly cash flow from multiple doors. The deal usually generates enough profit to completely pay for a professional property management company. They take over 100% of the phone calls, maintenance tickets, and tenant disputes, making the investment truly passive for you. Are you considering buying your first rental property or expanding a portfolio? What is Helium-10? Helium-10 is an all-in-one software suite designed for e-commerce entrepreneurs, brands, and agencies to run and scale their businesses on Amazon, Walmart, and TikTok. It is the industry standard toolkit for third-party sellers. Instead of guessing what to sell or how to rank on the first page, sellers use Helium-10's massive database of millions of data points to make decisions based on exact search volumes, revenue estimates, and competitor data. The core features. How sellers use it. Helium-10 is divided into dozens of individual mini tools, but they all serve 4 main pillars of an e-commerce business. Number 1, product research, finding what to sell. Black box, a massive database filter. A seller can type in "show me products in the home and kitchen category that make at least $10,000 a month in revenue, have fewer than 100 reviews, and sell for over $25. It instantly generates a list of low competition, high demand product ideas. The Chrome extension, X-Ray. This is a tool you turn on while browsing the actual Amazon website. It acts like an X-ray machine for any search results page, displaying estimated monthly sales revenue daily trends, and exactly how much Amazon will charge the seller in fulfillment fees for that specific item. Number 2, keyword research and SEO. Cerebro. You can paste the product ID code of your biggest competitor into Cerebro. It will instantly spit out every single exact keyword that competitor ranks for, how much search volume those words get, and which words are generating most of their sales. Magnet. You type in a generic term like chef knife and it generates thousands of related high traffic search terms you should include in your listing. Number 3, listing optimization, writing the product page. Frankenstein and Scribbles. These tools take thousands of target keywords and help you cleanly sort them into your product title, bullet points, and backend search terms. It checks off words as you type them to ensure your listing is completely optimized for Amazon's A9 search algorithm. AI Listing Builder integrates ChatGPT style AI to automatically generate optimized product descriptions and bullet points using your harvested Helium-10 keyword list. Number 4, operations and analytics, running the business. Profits, a real-time dashboard that pulls your true financial numbers straight from Amazon. It subtracts your advertising cost, manufacturing cost, shipping, and return fees to show your exact net profit margins. Alerts and hijacker protection. Monitors your listings 24/7. If another seller attempts to counterfeit your product, would attempt to steal your buy box, or change your product images, it sends an immediate text notification to your phone. Helium versus the competition. The e-commerce software market is highly competitive, but Helium-10 generally divides the market with its main rival, Jungle Scout. The pricing catch. While Helium-10 offers a highly restricted free version, its paid tiers operate on a steep subscription model ranging from roughly $39 a month for beginners to over $249 per month for diamond professional brands. Because it is an expensive investment, most sellers only subscribe once they are actively ready to launch or scale a product line. Are you researching Helium-10 to start a side hustle, or are you scaling an existing e-commerce brand? What is Amazon FBA, and what are the exact steps to start a private product business? Amazon FBA Fulfillment by Amazon is a service where Amazon handles all of your logistics in exchange for a percentage of your sales. Inside an Amazon FBA Fulfillment Center, a private label business model means finding an existing unbranded product from a manufacturer, customizing it slightly to improve it, applying your own brand logo and packaging, and selling it as your own unique product. Because launching a private label brand requires capital and strict execution, you must follow an exact chronological process to avoid losing money. The step-by-step private label sequence. Number 1, conduct product research. Number 2, source a manufacturer. Number 3, differentiate and finalize branding. Number 4, set up your legal and Amazon accounts. Number 5, place your bulk production order. Number 6, ship inventory to Amazon FBA. And finally, number 7, launch and optimize PPC ads. Financial reality check. What does it actually cost? While online gurus claim you can start with a few $100s, a realistic private label launch budget looks like this. Let's take a look at this chart. Before sending a single dollar to a factory, verify that the product layout does not have an active utility or design patent in the country you are selling it to. If you accidentally copy a patented design, the patent holder would file an infringement claim with Amazon, and Amazon will instantly freeze your account, destroy your inventory, and permanently hold your funds. Are you ready to map out a budget, or do you want to dig deeper into identifying winning product ideas? Do you have any more financial advice to give to me? The financial order of operations. Number 1, keep the lights on buffer. Number 2, capture the free money. Number 3, crush high interest debt. Number 4, build a fully funded fund that would be for emergencies. Number 5, fund your future using the 15% rule. Walk me through how to build a simple, realistic monthly budget using the 50-30-20 rule. The 50-30-20 rule is one of the most popular budgeting methods because it completely skips the headache of trafficking 50 different tiny categories like latte, spending, or streaming apps. Instead, it splits your money into just 3 big buckets based on your take-home pay. An exact step-by-step breakdown explains how to calculate your numbers and structure your monthly income. The 50-30-20 bucket breakdown: 50% for needs, 30% for wants, 20% for savings and extra debt. The step-by-step budget setup. Number 1, calculate your net income. Look at your actual paychecks for the month. Do not use your gross salary. You need the exact amount of money that is direct deposited into your bank account after taxes, health insurance deductions, or automated 401k contributions are stripped out. Number 2, run the percentages. Multiply your total monthly net income by 0.50, 0.30, and 0.20 to find the exact dollar amount for your 3 buckets. To find out what would be the limits for your 3 buckets. Number 3, list your fixed needs first. Write down the exact monthly cost of your absolute essentials, rent, utilities, insurance, loan minimums, and subtract them from your 50%. If your mandatory bills would take up more than 50% of your income, it means you are likely overextended on house or car payments and will need to temporarily shrink your wants bucket to cover the difference. Number 4, automate your 20% savings. The easiest way to stick to a budget is to pay yourself first. Set up an automatic transfer with your bank so that the day after your paycheck drops, your 20% savings portion automatically slides directly into your savings or investment accounts before you even have a chance to see it or spend it. Number 5, track and spend the rest. The remaining cash belongs in your 30% wants bucket. You can track this however you like, using a simple spreadsheet, an app, or by opening a separate checking account just for fun spending. See it in action. This will be an example of a $4,000 per month plan. The minimum debt trick. One part of this budget trips almost everyone up. Where do loan payments go? The minimum required payment on your credit card, student loan, or car loan begins in the 50% needs bucket. Any extra payments you make above the minimum to crush the debt faster belong in the 20% savings debt bucket. Now that you have the basic math framework, how should we customize this for your life? Where are the most popular places families go for summer vacation with kids and without kids? I believe families are supposed to have an IES, but that's okay for now. Where people choose to go for a summer vacation depends heavily on whether they are packing strollers and juice boxes or just a couple of carry-ons. The Ultimate Summer Travel Roadmap highlights the most popular destinations split by the type of trip you are taking. When traveling with kids, the best destinations have a high density of activities, easy logistics, and built-in distraction mechanics so parents aren't constantly fighting screen time battles. Number 1, Orlando, Florida. The vibe: high energy, immersive, and highly scheduled. For the kids, there's Walt Disney World and Universal Orlando Resort. Parent survival tip. Build a pool day in the middle of the week to rest everyone's feet and utilize the park's rider switch options if you have kids of varying heights. Number 2. Yellowstone National Park. For families looking to swap theme parks for the great outdoors, Yellowstone tops the list as a living science textbook. The vibe? Adventurous, outdoorsy, and visually jaw-dropping. For the kids, watching Old Faithful erupt, witnessing the rainbow colors of the grand prismatic spring, and spotting wild herds of bison, elk, and the occasional grizzly bear from the safety of their own car or boardwalks. The bonus: the park features a robust junior ranger program where kids can complete educational activity books to earn an official wooden ranger badge from a park staff member. Number 3. Coastal beach towns. The East Coast pick, Outer Banks, or the West Coast pick, San Diego. And these ones would be the adult-only vacations, Napa Valley, California. Number 2, Turks and Caicos. Number 3, Charleston, South Carolina, and Savannah, Georgia. Summary: the summary trade-off. Are you looking to plan a trip soon? Let's narrow down the logistics. What is a virtual biology lab? A virtual biology lab is an interactive digital platform or software simulation that replicates a real-world scientific laboratory environment. Instead of walking into a physical brick-and-mortar room to handle real glass beakers, live specimens, and hazardous chemicals, users sit at a computer or wear a VR headset and use 3D digital models, animations, and sliders to run complex biological experiments. Think of it like a highly detailed video game, but instead of scoring points, you're studying cellular respiration, performing genetics crosses, or analyzing DNA sequencing. How does it actually work? In a virtual lab, you interact with digital versions of standard lab equipment using your mouse, touchscreen, or virtual reality controllers. Digital microscopes. You can choose a sample like a human neuron or plant tissue, place it on a virtual stage, adjust the coarse and fine focus knobs on your screen, and zoom in to examine the cell wall or nucleus. Pipetting and mixing. You can physically click and drag virtual micropipettes to transfer precise microliters of fluid from one test tube to another, triggering digital chemical reactions or color changes. Time-lapse controls. In a real biology lab, waiting for a plant to grow or a bacterial culture to replicate can take days or weeks. In a virtual lab, you can adjust environmental variables like temperature or light, and click a fast forward button to see generation cycles or ecological changes happen in seconds. Common types of virtual biology experiments. Number 1, genetic and DNA manipulation. Number 2, molecular and cellular biology. Number 3, ecology and evolution. Number 4, virtual dissections. Why schools and universities use them. On the left side we have the benefit, and on the right side we have what it means in practice. This would be the limitation, what virtual labs can't replace. While virtual labs are incredible for teaching abstract concepts and the mathematical logic of science, they cannot completely replace a physical lab. They don't teach hand skills such as the physical muscle memory required to delicately steady a shaky hand while slicing a tissue sample, calibrating a real-world scale, or mastering a real-world spatial troubleshooting when physical equipment acts up. For this reason, higher-end institutions use virtual labs as a pre-lab tool so students can practice online before stepping into a real physical laboratory. What are the philosophies of wealth? Throughout human history, how we view money has never been just about numbers. It is about human nature, ethics, and freedom. Thinkers, economists, and cultures view money through widely different lenses. The major philosophies of wealth can be divided into distinct frameworks, ranging from ancient schools of thought to modern economic mindsets. Number 1. Classical philosophy. Wealth as a moral tool. Ancient philosophers did not care how much money you had. They cared about what that money did to your soul. The Aristotelian view. Oikonomia versus chrematistics. Aristotle divided the pursuit of wealth into two completely different categories. Oikonomia, household management, and chrematistics, the art of wealth accumulation. The Stoic view. The Stoics believe that true wealth is a state of mind. The blueprint. It is objectively better to be rich than to be poor, but wealth does not add 1 ounce of value to your character. The core Stoic rule is to enjoy your wealth, but never rely on it emotionally. Historical and economic philosophy. How wealth built society. As humanity entered the industrial age, philosophers shifted from looking at individual morality to looking at how wealth structures civilizations. The Adam Smith view. The moral free market. Often called the father of modern capitalism, Adam Smith's philosophy in The Wealth of Nations is frequently misunderstood. He argued that when individuals act in their own self-interest to build wealth, an invisible hand naturally drives them to create products, hire workers, and build businesses that lift up the entire community. The nuance. Smith was a moral philosopher, not a ruthless capitalist. He believed the ultimate goal of a wealthy nation was to take care of its poorest members, and that a free market only works if it is guided by empathy and justice. The Marxist view. Wealth as exploitation. Karl Marx looked at the same industrial world as Adam Smith and saw something entirely different. In Marxist philosophy, capital wealth is inherently exploitative. Modern behavior philosophy. Wealth as freedom.
In the modern era, the philosophy of wealth has shifted back to the individual, centering heavily on the concept of time ownership. The psychology of money. The psychology of money view. Rich versus wealthy. Being rich is a current income status, driving a $100,000 car or living in a mansion. Being wealthy is the stock portfolio, the savings, and the assets you choose not to spend on flashiness. The core axiom. The highest dividend money pays is control over your time. True wealth is the ability to wake up in the morning and say, I can do whatever I feel like. Wealth as experience capital. This framework views money as nothing more than a tool to manufacture life experiences. And this is the summary of wealth frameworks. We have the philosophy to the left, the core belief in the middle, and the ultimate goal of money to the right. Which school of thought aligns most closely with your personal goals?